Okay, so let me decode what is EPS and how does it work. Earning per share. So in EPS, the one more thing is which is very important. So we are talking about here earnings. Okay. But while calculating earnings, means once the company, let's say they have calculated profit, their net profit, but out of the net profit, you would see a categorization of dividends. Company, if company has, let's say, equity shares as well as preference shares, then company cannot directly distribute dividends to the equity shareholders. Before that, company will have to uh, you know the first deduct the dividends of preference shareholders, and then the remaining amount, means after deduction of the preference shareholders dividend, then remaining amount company will distribute to the common equity shareholders. And when we calculate, let's say, earning per share, so earning per shares required the income net income. See, even yesterday also we have calculated the profit and loss, right? P&L, profit and loss. But that profit, let's say it was a gross profit. It wasn't a net profit. Or other way around, let's say it was a net profit, but the after net profit only, once you have a net profit, then you can deduct the preference shareholders dividend amount. And then on remaining amount, that remaining amount you can consider for a calculation of earning per shares, right? So the assumption here is same example will refer it. So let's say same company now publish 1,000 rupees as a net income, and company has total 5,000 outstanding shares or shareholders. So apart from, let's say, 5,000 shareholders, let's say, total shares 5,000, preference shares, let's say thousands, and common shares quantity. Let's say this is the breakdown of company's total shareholders pattern. Means company has preference shares, company has common shares. So now let's say company earned profit of if you're let's take this one, the third quarter. We are talking about quarter third. Let's say, right? And in a quarter third, we have 5,000 rupees as a net income. So this 5,000 rupees net income. So out of this net income, guys, we need to first deduct the preferred shares dividend. And let's say preferred shares dividend is 1,000, because they'll have a fixed percentage. For a preferred, shareholders, they receive preferred or flexible, but they receive uh, dividends continuously from company. It's like an interest payment only, because preference equity itself, it's a hybrid security. Hybrid, it means preference shareholders carry mix features. like regular dividends or redemptions at maturity or conversion of preference shares into common shares at maturity. So they carry basically, mix feature, right? So it means out of the net, income from the operations, company need to first deduct the dividends payment of preference shareholders first, and then the remaining amount would be, means net income from means after the deduction of preference dividend. So total amount would be 4,000. So this 4,000, basically you need to distribute to the common shareholders. And this is what your earning per shares come into picture when we talk about earning per shares, right? So earning per shares, company need to distribute to the common shareholders, or common shareholders basically they calculate the EPS, earning per shares. Even preference shareholders also calculate EPS, but the ratio or the way of, we calculate the earning per shares for common shareholders. So same pattern you can apply it to the preference shareholders as well. But but in this, context, we are talking about the common shareholders. We are talking about common shareholders and their the earning per shares, right? So since we know it, what we have income. We know the preference shareholders the total dividend amount, right? And we have a net income from the after deduction of preferred dividends. So let's calculate it now. Net income, total net income, which is as per this example, what we have, like 4,000 rupees. Total net outstanding quantities, outstanding quantity, we have around 4,000, right? And just divide this means total net income. You can divide with total, quantities, whatever quantities that we have, and you will have EPS per share, EPS, earning per share, right? So calculate it. So in this case, the earning per share would be 1 rupees. So any question? How did I calculate it? I have simply considered two factors. One is your net income that I have divided with outstanding shares, but all are common shares. So don't mix common and preference together. And then finally we have earning per shares, EPS, which is 1 rupees. Why? Because the common shares, which are 4,000, correct? So this is how we calculate earning per shares for a company. But now, as an investor, or let's say as a investment banker or financial analyst for that matter, how we can read to this? See guys, earning per shares which talks about the potential of the business. What it means in this case, the potential of the business is like other way around. For 1 rupees investment, right? For 1 rupees investment, the business is earning 1 rupees. So basically, in this case, business has 100% capital appreciation, sorry, return on investment, right? So business is basically delivering 100. See the per share price, if you have a 1 rupees per share, but anyways, in this case, I think the per share price of the dividend is different, right? But for per shares, what we are earning, sorry, the investment would be wrong. So for one quantity, the earning potential is 1 rupees, right? So here in this case, we are just only talking about we are only talking about the per quantity, that how much we are earning, or the per unit of, let's say, equity capital, say how much the dividend is going to receive from the company, because this is basically, it's an income of shareholder. So if you hold, as an investor, if you hold, let's say, 1,000 units, then 1,000 into 1, so you can earn 1,000 rupees dividend or income from the company. So basically, you have invested XYZ amounts, right? And this amount you can compare with the investment, like how much company that they have, let's say, offer as a dividends or income to the business, to the investors, or to the, let's say, shareholders for per unit. So earning per shares, or EPS, which only talks about the earning for per units. And why it matters? Because it tells investors how much profit is earned for per share. And if you want to read it, let me just brief about the technique behind it, to read. Higher profit or higher earning EPS, the more, you can say, like, more, profit for shareholders, and more profit for shareholders, it means for you, it's a attractive investment opportunity. Now your question would be how. For example, let's say, if there are two companies, company A and company B. For both the companies, let's say both companies, they are from same segment like IT, or could be banking, and you have invested same amount in both the companies. Like, let's say, you have purchased 1,000 shares in both the companies, company and company B. Company A is offering 1 rupees earning per shares, and company B is offering, let's say, 0.5 rupees earning per shares. So in this case, you're going to receive 500, and with the company A, your earning would be 1,000 rupees. Now, if you look at the, amount, guys, see, if you receive the same amount every quarter, because quarterly, basically, companies publish financial results, your total earning would be 2,000, and here your total earnings would be 4,000. So you see a difference, and assume it, if you reinvest this amount, reinvest this amount and earn, let's say, at least 10% from debt investments. So you're going to make again 400 rupees as an extra, right? And in this case, if you reinvest the same amount, and let's say even if you receive the same sort of the return on investment, which is debt, so your earning would be 200, right? But anyways, so you're not going to receive that in one go. So every quarter you will receive it. So you might see change in this earning, right? Every quarter, it means first quarter your income, that you can charge only on thousands, and then 2000s and three, and so and so. But maybe let's say from next year you will have, you have received now 4,000 from company A and then 2,000 from company B, and if you start investing, so you can, multiply your investment quickly, right? So what it means in a finance, we have a compounding pattern. So compounding, it means, so whatever return that you're going to receive from the investment, you can reinvest that and multiply your investment. That's what the experts, they talk about, the magic of compounding. So magic of compounding is very simple. You have invested 1,000 rupees, you have received dividend of, let's say, 100 from the company. So next year your total wealth would be 1,000 plus dividend, right? So that is 1,100. And if you invest, let's say, same 1,000 plus 100 dividend, maybe in different instruments. So for a next year, you can calculate total return on 1,100. So this is whatever profit you have received from the investment, so that profit you can capitalize. Okay. And from the investment perspective, if you ask me, means to just summarize how we read this, you should look for, so the base is, always pick the two companies from the same segment. Do not pick companies like, let's say, one company is from IT, another one is from banking. And if you try to compare earning per shares, this won't be like apple to apple comparison, and you should not do it, right? You cannot compare means two companies from a different industry or different segment. If you want to compare, pick the two companies from the same segment with a similar size, won't be exactly, but similar size that I'm talking about, and then compare earning per shares. If that, let's say, XYZ company is offering more earning per shares, then you should pick that stock for an investment. You get it, my point? So I'm saying you should pick two companies from the same segment, let's say IT. For example, uh, Wipro and HCL. Almost, both companies has similar size, 3 to 4 lakhs crores something, right? Now you can pick that, the Wipro and, there's two companies, and you should then perform the earning per share analysis and check which company is offering better. Let's say Wipro is offering 1 rupees for per share every quarter, so it means 4 rupees for per year, and the HCL is offering 2 rupees for per shares every quarter. So it means you are going to make, let's say, 8 rupees something, the return on investments from the, means as income from the HCL. Then I would prefer to invest in HCL, not with Wipro. Because if I invest with Wipro, so I'm going to lose more income or earning per shares. You get it, my point? See, this has nothing to do with companies' financials. This is something for us. So it means for investors. The earning per share is a part of market ratio. So it means market investors, they read this information. They need this information to read. The attractive earning per shares or higher earning per share, so it means more attractive, or the meaning of the more EPS is, the business is making good progress, or business, let's say, which is generating more and more revenue. So in short, the business is in a sound position, and then business continuously offer a good return on equity. Why we have a stories for Wipro, or why we have a stories for Infosys, why we have a stories for HDFC, why we have a stories for Reliance Industries? Like, you would have heard maybe from someone, or maybe you would have seen in the news, like if you would have invested XYZ amount, so same, the XYZ amount become now would have multiplied into X, triple X, fourth X kind of, right? So for example, let's say if I talk about MRF, in 2006 or 2002, the share price which was at 1400, right? So if you would have invested your money 14, let's say 1400 in a one stock, so same price now, the MRF stock price which is at 1,48,000, it means your amount would have multiplied, because in this chart if you see, the 7,691% return the stock has delivered. But this is again, it's a value that the stock which has generated. But apart from value, even the stock has offered the dividends continuously. If you can go and see, let me go to the corporate action section. Let me, there is a site I think on NSE or BSE something. Okay, instead of wasting time, let me go to the GPT, and can you share the dividend? Yes. Look at this. Continuously, share has offered dividends. Right, in 2020, offer 3 per shares, then 3 rupees 94.50, 3, 3, 144, 3. So means almost around 200 uh, rupees dividend that stock, continuously has offered. Continuously, it means continuously. Even in 2025, offer dividends of 229. Apart from value, right? Apart from value, this particular stock is offering dividends as well. So now if you want to compare two stocks, which one is better and which one you should prefer for an investment, so you should prefer a stocks with highest earning potential. Why? Because that stock only, continuously it will grow. Continuously, it means continuously. There are two things. Earning per share, which talks about the potential of a business. Even if business, let's say, don't want to distribute as a dividend, they'll reinvest it. And even if they reinvest, so basically that valuation impact you can see on per share price basically. So per share price will increase. Automatically equity's value, which will increase, and which is fine, right? But the business or the company that you should choose for an investment, which is the higher earning per share company. So if you have any question, please do let me know. But in an interview, you may see questions like, the interview will say, look, the company ABC earned XYZ amount of profit and the outstanding shares are this and this. So can you please calculate the earning per shares for this company? So you may see questions like this in your interview. I still remember my first interview, so which was with Eclux, and the guy asked questions like, let's say I'm from XYZ company and want to now distribute dividends. So or earning, we have profit, let's say earn profit of this. So how will you calculate earning per shares? So you may also see questions like this, but that depends. So I hope now you get it, and I think this is enough. And to just summarize, the industry range and all. So basically, high P stocks, right? Sorry, the high EPS stocks, investors they prefer to invest, but poor EPS. If you see any poor EPS, earning per shares, that doesn't mean you should not invest, but you should check the factors, because earning per shares, more earning per shares only, which talks about those stocks would be more attractive to invest. That's how you can take the you know understanding from this earning per share. And this is not for a company, even company also calculated, but for investors what matters is like the, let's say, attractive earning per share, which is a good for investment, and even for an entrepreneur or businessmen or founders, and if they want to check the earning per shares for their own business. So earning per shares, if let's say if they compare with their competitors, right, and if their earning per shares is better, so it means they're growing or they have a robust business model, and definitely you would see continuous growth in that business also. Okay, so this was all about earning per shares. Now the next would be price to earning, PE. So any guess for P, guys? How can we calculate price to earning? How can we calculate price to earning? I'll give you 2 minutes to think over. So tell me, how can we calculate price to earning ratio? Come on. See, in this ratio, price to earning, the base remains same, which is net profit, or let's say total income, that uh, we will compare. Okay, but the earning here, so basically if you want to calculate price to earning, then first you need to calculate earning per shares. If you have earning per shares, in this case we have earning per shares of 1 rupees, then you can easily calculate price to earning, right? Because in this ratio means the price to earning ratio, we are talking about the price which we are paying in the market to purchase that particular stock, right? Let's say the purchase price is X. So that X price you can compare with earning per shares. You can compare with earning per share. Simple, because earning per shares we have means the net income splitted across number of outstanding units, but in a price to earning we are going to compare the earning for per shares with market price. Okay, so there are two components. One is price. Price, it means it's a market price. Okay, and the another factor is EPS, earning per share. So that EPS you can compare with market price. Let's say the market price of the stock, which is at P. Let's say you have one shares with market price of market price with 180 rupees that you're paying, and against the 180 rupees you have, let's say, earning per shares, which is calculated EPS 1 rupees. And if you calculate now PE, let's calculate it. 180 divide 180 divide with 1. So the PE is at 180x. We calculate in x. So what it means, the the PE ratio which is higher, right? So for example, now to understand this logic, how means you can read the price to earning ratio. See, as a buyer, when you buy the investment, guys, buyer is paying 180 rupees, paying 180 rupees to company to earn 1 rupees as a net income. Did you get this? What we are saying? As a buyer, buyer is paying 180 rupees to the company to earn 1 rupees as a net income from the operations. Now, how we can read this while taking investment decisions? Let's say you have a company A with uh, let's say 20x, and company B with 180x. Now, if I ask this question, because in case of company B, the P ratio is 180x, and in case of company A, the P ratio is 20x. So, which one you would prefer to invest? In company A or in company B? If you ask me, in my opinion, we should invest in company A. Now, your question would be, sir, why not in company B? Because company B has a higher P. Agreed, company B has a higher P, but if I, let's say, increase, let's take a means numbers to discuss this. We'll do a comparative analysis of two companies together, and then you can decide how calculations derives actually. Company A market price, which is at, let's say, sorry, company B 180, and earning per shares EPS, which is 1. 180x, right? And in other case, so 20x, it means, let's say, the stock price maybe which is at 20, let's say 20 divided with 1, 20 rupees, and earning per share which is 1 rupees. So your EPS is, sorry, P ratio is 20. Now you tell me, you know, in which company you would invest. I told, because I would prefer to invest in company A. Why? Because see, if company A is saying they need just 20 rupees from us to generate 1 rupees, right, as a profit. In case of company A, what they are saying, guys, they need a 20 rupees of investments to generate 1 rupees. And company B is saying they need a 180 rupees to generate 1 rupees. So in case of company A, the logic is with a minimum capital, they are generating more profit. And in case of company B, with a higher capital, they are generating just 1 rupees. So it means lower profit. So more P, which is not a good. So max your PE ratio, it should around the PE ratio, which should around 20 or 19, 20 or 20, 25 max. Even very lower P is also not good. Even higher P is also not good. It should somewhere between 15 to 25. So that will treat as a reasonable, because the more P, in case of Adani Group, they had a higher P, and that's what the more experts, they were very cautious about. They were cautious about the valuation, right? See, if you're paying 20 times extra to acquire that particular stocks, or acquire, let's say, or to earn 1 rupees, which is still fine. Again, it's not my opinion. I'm just talking about the expert's opinion. And there is nothing like concrete or something, as per legal, company should post 19x or 20x. 20x is ये multiplication है. We are just multiplying. So it means For example, let's say you'll have to invest 20 rupees to generate one. So it's just a multiplication. X, it means we are just multiplying it. So अदर वे अराउंड हिंदी में मुझे ऐसे कहते हैं कि मैं 19 गुना ज़्यादा पे कर रहा हूँ आपको अर्निंग से, काइंड ऑफ, राइट. So if I summarize now price to earning, to calculate guys P ratio, we need current market price. Okay. The first factor is we need current market price. Then apart from this, we also need earning per shares. We need earning per shares. To compare earning per shares with market price, the more PE, which is not good, so that trigger to the higher or lower valuation of the business. So it means business valuation is not good at all. All right. Then again, the lower, very lower valuation may even trigger, the undervalued stock, because so it means company is generating profit but nobody is paying price to it, again, which is not a good, other way around. So it means if company is, let's say, generating decent profit but still investors, they are not ready to pay higher price, which is not also good. So the reasonable would be 19 to as I said, 15 to 25 x in between, if you're paying extra, which is, or which could be reasonable or decent, as simple as that. But apart from this, again, on the basis of certain numbers or data, you should not quickly take investment decisions. You should do a thorough forensic audit or analysis of the business, check the allegations, regulations, other things as well, because recently what happened in a gaming industry, like government banned all the gaming apps, and maybe very soon, if the government get the nod from the upper house, then it will convert into act 2025, the gaming ban act. And ultimately, the people who have invested money in a gaming industry, they lose their money, right? So means beyond the metrics, you should also follow the news as well, news or government regulations, uh, or acts. Then again, political, let's say, political opinion about that particular group. There are a lot of things. Ratios are just for to understand the position of the business, but if you want to take a investment decisions, so only ratios cannot help you to take investment decisions. Ratios only give you a sense whether you should invest or not. But apart from this, you should also check the other factors as well. Could be political, legal, business model, management view, and so on. So, okay. This was all about price to earning ratio. Then the another one is uh, dividend yield. So can you tell me, or can you guess how can we calculate dividend yield? Come on, I'll give you 2 minutes to think for, so you can try to answer. Dividend yield. How can we calculate dividend yield? I'll give you 2 minutes. Think and try to post your answer in chat box. All right. So let's talk about dividend yield. See, dividend yield is nothing but it shows return, basically return from your investment paid back to the shareholders as a dividend, right? See, if company, let's say, has earned profit of 1,000 rupees, so that doesn't mean company will return 1,000 rupees back to the investor. Okay. No, they'll not return all the money, whatever that they have earned. So when company earn profit, let's say company, when company earn total profit, so they basically park, that profit in different accounts. And before that, they also fulfill the other obligations, as I said, interest payment or pay for dividends and all of this. And even they park amount in the reserve accounts for a future expenses. Let's say when company earn profit, so company will put money in reserve account. It could be capital reserve. It could be cash reserve. It could be other reserve, or free cash for working capital. They need it, right? Let's say company earned 1,000 rupees. Out of this, company decided to transfer 200 to the capital reserve, then 100 to the cash reserve account, and then 50 to this, and 50 with this. So the net capital, if you see, sorry, net profit, net to distribute, which is 200, 300, 400, 600 only. All right. So now we are talking about this amount. We are not talking about, sorry, my bad. Because the earning per shares, which talks about total profit or total earning, this portion. Okay. The earning per shares talks about total profit. Even your earning per shares also talks about total profit. P ratio also talks about total earning. But in this case, we are talking about the net amount which is available for a distributions for per share. Net amount. How much is the net amount? Let's say, company want to distribute to the shareholder. And in this case, company is ready to distribute 600 to the shareholders. Same example, refer it. Total shareholders. We have total shareholders of 4,000. You can refer from here. Let's say the first company, total outstanding quantity after, means will not consider preference shareholders, will only consider the net common shareholders quantity, 4,000s, right? Then net dividend amount that company want to distribute. Let's say 600. Then DPS, dividend per share, calculated total amount, dividend, net dividend amount. We have 600 divide with 4,000 shares, like 0.5 rupees the company is going to distribute to the investors as a dividend, and investors will receive this. All right. So this DPS amount, basically you need to convert into percentage, and the base would be, to calculate yield, the base would be let's say EPS, earning per share, that you can divide with market per share, market price per share, into 100, because basically the dividend per share amount you need to convert into percentage, as simple as that. So let's now convert into percentage. 0, the DPS, which is 0 point, sorry, 15 rupees, convert into let's say market price of a per shares. You have two companies, but we are talking about this one, uh, first one. The market price of per share is 180, market or current price. Let's say 180 into 100. Tell me the the answer if you can calculate it. 0.15 divide with 180 into 100. So in a percentage, if you try to put this 0.15 divide with 180 into 100, 0.0833 something. So now how we can read to this, guys? See, more dividend yield, again, more dividend yield, which is a good, and that basically from the investor's perspective. So you should try to look for opportunities like which offer more dividends. For example, let's say BPCL or HPCL companies, they are government companies and they offer attractive dividends to us. So same dividends as an investor we can accumulate and invest the same amount, means the whatever dividends that you have received in other investment asset class to multiply your income or value, asset value, whatever that you want to multiply it. Correct? So in short, dividend yields, why it matters, because the more or high dividend yield, I would say, which attracts income focused investors towards the stocks, because there are people who want to diversify their stock portfolio as well, like 30 to 40%, the investment, basically they want to invest in a highly dividend yield stocks. So continuously, they'll receive the additional income. So without selling of a stocks, they can enjoy the liquidity and manage their financial goals, right? And rest other, maybe you can diversify in a different way, maybe in a mid cap or large cap, or so on and so forth. Depends, means how, see, there is nothing is like scientific approach. Someone will say 20% you should invest in a highly dividend yield company, someone will say 50% you should invest it, but everything which is uh, more aligned with your personal investment objectives and risk capacity, or the the expectations, personal basically expectations from the investment. And I think that will help you to diversify your portfolio and to take investment decisions, like how much percentage that you can put your money with highly dividend yield stocks. But in short, if you ask me, uh, you know you should consider the high dividend yield stocks. But again, guys, there are factors. If you go and see a price of BPCL, if company is, you cannot see growth if company, let's say, continuously offering dividends. So it means you cannot expect appreciation in stock price. Why? Because company is not reinvesting. Company is not reinvesting the profit, whatever that they have generated. Basically, they are distributing that profit to the investor. So it means that amount eventually it will remove from the balance sheet, right? If company distribute the dividends. So you cannot see the price change, like positive price change of that particular stock in the market. If company continuously distribute dividends, then definitely the you can see a impact on the stock price. But that doesn't mean stock price like negative the price like negatively impact in the stock market. But you cannot you know see a growth like maybe 30%, 40%, or 100% appreciation in 1 year or two. So it will take time to get the uh, basically good value from the investment. So there are two things. One is, what's your investment goal? You want a good, let's say, the value from the stocks, you don't want a dividend, then you can prefer other stocks. But if you want, let's say, your priority is not uh, huge value appreciation, you are just looking for an income opportunity so that you can continuously generate positive return from your investment. So in that case, you should look for companies like BPCL or HPCL or IOCL. They offer continuously uh, dividends on investment. Look at this. There is no big price change in the market price. But if I ask for chart. Just will quickly see it. BPCL. There is one more agentic AI. Let me just search on that site. It's a failure. Oops. I don't want to download anything. I just want to do analysis. Why it is taking time? I don't know. But because nowadays Google is not working, right? So it will take time. But anyways, you can also, I mean, track the, you can check the track record of BPCL. Every year they offer, the good dividends to their investors. So it's on you how you want to diversify your portfolio. If your priority is dividends, you can, look for dividends oriented stocks, but they have continuously, offer dividends to the investors, right? So these are the market ratios like uh, price to earning or dividend yield, earning per shares, dividend, earning per shares. There are more, even means beyond that, there are more and more ratios. But again, you should continuously, go through the financial data, try to understand different, ratios. So that's how you can gain the control on it. And see, if I summarize, means your question would be, sir, can I take the investment decisions on the basis of whatever ratios that, means what we have discussed? The answer is no. Because ratios, give you only a sense on the basis of the data which is exist on internet or on paper. You get it, my point? But that the data can be manipulated. We have seen in Harshad Mehta, we have seen in Satyam scandal, we have seen with in a lot of companies how they have manipulated the financial numbers, uh, and you know and at the end announce bankruptcy. There are fake business models also in the industry. How they do it, I'll just give you in a brief about it. I don't want to reveal the name of any company, but how actually they run this game, I'll tell you. So it means because the ratios and everything which is based on the information which is available